So great to have you here. So you have an incredible life story that I would love for you to share about why you became so inspired to found Divvy. So if we can just start with talking about your background, your story, and why this mission matters so much to you.
Sure. So first, I just want to say thank you to Catherine and David Yulovich for putting this on. There aren't many conferences where we get to celebrate companies that focus on this topic, and so thank you for showcasing us. Also, she's growing a baby on stage while she's hosting this.
It wasn't obvious.
Come on, everyone. The most impressive.
True dynamism.
So I'll give you a little bit of my background, and then we can dive into a little bit more about Divvy and what we do. So as Catherine mentioned, my goal at Divvy is to make homeownership accessible. And this mission is so meaningful for me because for my family growing up, owning a home was everything. My dad had immigrated from Israel. When he came to the US, couldn't speak English, didn't have a FICO score, met my mom, and they got pregnant. It was the 80s, and they were like, okay, now what do we do? And they were like, okay, we should find a home, and realized that they couldn't get a mortgage. They were really fortunate that they found a woman who gave them seller financing on the home. 34 Abbey Drive, they had 3 additional children in that house, so 4 total, and every time one of us went to college, they would refinance and cash out. They finally were able to get a mortgage, and they would refinance the property and cash out and use that cash to pay for me and my siblings to go to college. And you know, to me, this is the heart of the American dream, which is providing a life for your children, which is better than the one that you had, and doing that by being able to work, invest in property, and grow wealth for your next generation.
So, I mean, this is something, as you said, that everyone cares about. Politically, it's such a political issue on both sides. Everyone agrees, like, homeownership is the path to wealth creation in America. Why is it so hard for people to get a mortgage and for people to access affordable homes?
Yeah. So this is a fun fact. So I just did the new calculation today. Based off of our 7.15% average 30-year fixed rate mortgage, and then based off of an average home price of $400,000, which is the average home price in the US, only 20% of Americans, based off the median income at different levels, can actually afford a home. So 80% of Americans, people living in your districts, in the areas that you represent, cannot actually access a mortgage. And you might be saying, well, why? So there's a couple of reasons. I would say the biggest thing that it comes back to is that mortgages were created in the 1940s, right? That was kind of mortgages had been around for a little while, but they were actually first pooled and securitized starting right around in the 1940s when people came back post-World War II. And the underwriting criteria and the way mortgages were structured were determined then and have yet to evolve since that point in time. So the underwriting criteria, the down payment requirements, most of how the industry functions is almost 100 years old. And the last time we tried to innovate, as one of my board members who worked at Fannie Mae, she was the COO of Fannie Mae, she said it best, where she said, Adena, the last time we tried to innovate, we caused a global housing-led recession. So we're not going to do that again, or at least not anytime soon. And so the biggest reasons why people can't access homeownership today, number 1 is the down payment. Number 2 is FICO. Number 3 is income. The way that our population or Americans today make income is more varied than it had been in the past. And in the 1940s, we didn't account for things like 1099 workers, gig economy, people working multiple jobs, being self-employed. So these are all things that make it extremely challenging to get a mortgage, and it's something that we try to address at Divvy.
Yeah, so I mean, seeing those problems, knowing that those are the core factors why 80% of Americans are left out of this, how did you decide, okay, this is the business model we need to pursue with Divvy, and this is how we're going to fix the problem?
That's a great question. So I didn't wake up, so I'll give you a quick overview on what Divvy does for those of you who don't know. Divvy creates homeowners, and we do that through a rent-to-own program. The way that the rent-to-own program works is meant to mimic a mortgage. So a customer comes to us, we will underwrite them, and we'll say, hey, you're approved for, let's call it, $350,000 home in Atlanta, Georgia. Go out shopping. They get the budget the same way they would get a pre-approval letter for a mortgage. They go out shopping. They find the house that they want. So they are picking out the home. They bring the home to Divvy. Divvy buys that property for them. We take care of all the inspection, title checks, everything for them. They don't pay a single penny up until we're about to go to closing, at which point they sign a lease with an option to purchase. We ask them to commit 1% that we call, in very legalese terms, an initial savings contribution, but essentially it's like a down payment. So that's their initial equity skin in the game, which is 1%. And then every month when they move in, they make one monthly payment, part rent, part equity, the same way that with your mortgage you pay principal and interest, it's just rent and equity, and they can build up ownership. So their 1% goes to 1.2, 1.4, 1.6 every month, and we let them build up to 10% ownership over 3 years. And so that was the original product. At any point in time, they could roll that equity onto a mortgage, they can cash out their equity. The funny thing is that I came up with this model because I noticed that it was really hard to get a mortgage, and I thought, okay, there has to be a way to structure this. There has to be a way to structure it such that you're not taking credit risk on the individual. I locked myself at that time in my apartment, and I modeled out every way you can make it easier for someone to buy a home, the way that you could take, if they weren't going to be homeowners, they were going to be renters, and I thought, let me figure out a structure where this could work. I didn't know that the rent-to-own industry existed. I hadn't known its predatory history, and I just came up with this idea. And I actually got my first customer, Teresa Peterson. I got her by putting an ad up on Craigslist. I said, can anyone not afford a home and want me to help you buy it? And that was the first customer, and now tens of thousands of customers later, we're now offering this out across 20 different metros and 9 different states.
That's incredible. And one of the things I loved about your first customers too was that you were based in San Francisco, your team's based in San Francisco, but a lot of the first customers, the early markets you went into were Middle America. Tell us about how you chose your markets, how you decided that you wanted to work in states that are sometimes ignored by tech.
So the first choice to go in to a new market was quite easy. We had raised a $3 million seed round. And if you do the math and you're buying homes, $3 million doesn't get you very far in certain geographies. So I looked at a map and I said, where can we buy the cheapest homes in America so I can actually prove out this model and see where I can take it. And that took us to Cleveland, Ohio, which was the first market that we started in. And it worked remarkably well. And from there, we started actually getting more disciplined and taking a more quantitative approach to figuring out which markets we thought, one, we can serve the most number of individuals, two, where we can produce a really good return for our investors. My view is that you will not be successful in this if you don't produce good returns for your investors as well and can't build a big business. And since that time, our biggest market is in Georgia, Atlanta, Georgia, Florida, and Texas are our 3 biggest markets.
And tell us about some of the homeowners. I know you have really interesting stories about your first customers, the profiles. Like, tell us about who you were helping in the early days.
Sure. So our customers, on average, make a household income right around $100,000. There's usually a co-applicant, so it's 2 applicants usually on a given house, $100,000 of total household income. 51% of our customers are non-salaried, meaning that they're not W-2. They'll be 1099, hourly, so gig economy. 25% of our customers work in healthcare. So nurses, x-ray techs, teachers, transportation, warehouse facility, retail workers, all of those are kind of our core customer base. Over 50% of our customers are underrepresented minorities, and with our transactions, they're 80% female-led. And so those are just a little bit of the stats, but we're really proud to make sure that we're serving a population that isn't the coastal elites. We don't operate in San Francisco and New York. We don't plan to operate in those metros. And what we do is we provide a path for people who we think have traditionally been ignored by the financing options out there today.
And we see this with a lot. I mean, you mentioned rent to own and predatory history, how companies have done things wrong and how you didn't even know about them before you started the company. But it's like, we see this a lot with financial inclusion companies where technologists will come up with a model and there will be this sort of predatory history, or there will be this sort of negative connotation of, well, what are you doing to people in the press? Walk us through how you navigated that, how you've innovated on the model so that it's not predatory. Like, walk us through when you realized the history of this industry, how you could change it.
Sure, so let's maybe back up a little bit, which is the history of rent to own. Mostly it took off during the 1980s, and the reason why it was so categorized as predatory was because, one, the tenant didn't pick out the homes, so generally the homes would not have been kept up as well. Two, the tenant didn't build equity in the property, so they were just paying above market rent and generally couldn't save up for a mortgage to be able to ever buy back the property. And then the third major difference is they used to force the customer, which is illegal, to pay maintenance, taxes, and insurance on the property. So Divvy really takes a completely different twist to this, which is you are picking out the home, you are building equity in the property, and we are covering all maintenance, all taxes, all insurance. We are offering you free credit counseling. We're putting you on the right path. I also, though, take full responsibility that I've chosen to build a company in an industry that has a very tainted reputation, and it is on me to set the precedent of being able to provide what I think is a really great and fair product. So the ethos behind Divvy and all of our employees is every decision you make for our customer, make the decision that you would be making for your parents, for your family. So when you're setting the lease contract terms, when you're figuring out how to handle a situation, treat every customer that way. At first, this was really difficult. I spent a tremendous amount of time going through every detail of our lease contract, like nonstop worrying over every little thing we've done. And I wish there was guidance. I wish there was someone to tell me, right, here's what's okay, and then this is how you should think about setting the buyback price that the tenant can buy back the home at. So here's an example I constantly grapple with. The tenant eventually has to buy back the property. We use a third-party source because we wanted it to be completely separate from us to predict appreciation, and then in general, it'll average call it 5% a year. Well, in the last 2 years, as the price of homes started running up, you saw some markets that were appreciating at 15 to 20% a year. And I couldn't look my tenants in the eye and say, hey, your buyback price is going to appreciate over 3 years by 50%. It didn't feel right to me. So instead of using exactly what that third party said, I set a cap, and I said, we're not going to charge any more than 6% appreciation annually. And I don't know where to pull that number from, right? We obviously did a ton of analysis to get at that, but these are rules that you have to set and policies that you have to enforce when you're creating a new industry, right? Is you are setting the level at which you should be operating and what is required for the rest of your team. There's no right or wrong answer in a lot of these areas, in a lot of these industries, which are category creators.
Yeah, no, and we've talked a lot about the fact that, especially post-2008 in housing, but this is true for many different companies that are trying to innovate on models. You want to engage with the regulator very early, but oftentimes the regulators don't want to engage because there's so much worry that things could go wrong. These are very complicated markets. As you said, we want guidance, but sometimes giving the guidance, they don't want to be caught holding the bag. How does Washington work in some of these, these are the most important industries to Americans. Everyone wants to be able to build home ownership. How do you suggest that regulators work better with startups like yourself, with founders like you who want to engage early with regulators, understand what the regulations are, build the regulations for new industries together versus doing it alone and then asking for forgiveness if something goes wrong?
Look, I was having a debate with someone yesterday, who is the onus on? Right? Is the onus on government to reach out to us and say, hey, let's have a conversation? And truthfully, I don't think that's the case. I think the onus is on us companies to make sure we are opening up that dialogue, that we're showing up for events like this, that I'm actually reaching out and trying to have the conversation. I can promise you starting a company is not easy. You wake up, first of all, you wake up 5 times in the middle of the night. But when you finally get up at about 6 in the morning, you are online and working straight through the day. And to have to take a moment and take a step back and be like, oh wait, did I do the proper amount of government relations, or am I flying out to take care of this? It's hard, right? It's hard. We don't know who to talk to. I don't know who to reach out to. I don't know what the communication style is. And so I think we're trying to make inroads, but I think that using consultant firms or consultancy firms to help us actually make those connections and giving us a platform by which we can openly say, hey, I want to start this dialogue. Here is how you can reach out to us and use this mechanism, and this is the way in which you should get in touch with us and start to do that. I'd love to have that dialogue. And if anyone's in this room who actually works either CFPB or regulators, I'm openly saying I would love to be able to sanity check a lot of our assumptions against what y'all think.
Yeah. And I want to end by asking, you're one of the most thoughtful people on macro, on where the housing markets are going. I'm sure a lot of people in this room want to hear your predictions on what's going to happen over the next year, what we're seeing in the housing market. If you could walk us through sort of high level what you think is going to happen, obviously with the caveat that no one ever knows for sure. But walk us through sort of how you're predicting it. And then, the other thing we've seen too that we'll talk more about later today is, I was just sharing, I moved to Miami almost 2 years ago. We're seeing sort of this great migration that's really changing the housing market. So I would love your thoughts on that as well.
Yeah, I would say right now, if you look at any institution, whether it's an iBuyer, a single-family rental platform, Divvy, then we're not buying homes right now. Home prices are going to decline, and we're seeing it, and we're seeing home prices decline. Started probably back in the second week of July was when we really started to see the market soften. And as interest rates have gone up, we have seen home prices falling, and it's very geo-dependent, but in some places, upwards of 15% from peak already, which is a tremendous amount to see home prices fall in a very short period of time. So our view is, one, obviously inflation should be the core focus right now in getting that under control, but in raising interest rate, that passes almost directly through to the consumer in terms of what they're going to pay in mortgages. And what we are seeing is that demand is falling off a cliff. So people aren't transacting. It's quite a bit of stagnation. Now, when you parse down what does that mean, so transaction volume is down right now about 20% year on year. Home prices, if you take an average across America, it's only down 8% year on year. Sorry, it's up 8% year on year. And you might be saying, well, how did you say it's down from peak but still up 8% year on year? Well, we've had a lot of appreciation in the last couple of years. So while we're down from peak, you're still up on a year basis. Our view at Divvy is that we're going to start to see heading into Q1 year-on-year declines in home prices. Across economists, that is likely to be somewhere around 10 to 15% year-on-year home price declines. If you look back at 2009 to 2012, so home prices reached their bottom. So the bottom of the stock market was 2009. The bottom of home prices during the housing crisis was 2012, almost 3 years later. And when you look at where they were from peak to trough and how they fell off a cliff, it depended very highly by market. Some markets you only saw a 10 to 20% decline, and some you saw something closer to 40 to 50% decline. Florida was one that actually got hit quite hard. Overall, it averaged 30%. If y'all look at the run-up in home prices, since 2019 to 2022, home prices have gone up by about 50%. Right? So when you look at where we are going to come back down to, from that peak, I would imagine kind of what came up is going to come somewhat down. And so I think we might be falling further, at least when we get to the bottom, than we had in just from peak to trough in a quicker speed. Now, that's okay, right? Houses need to reset. This is part of inflation. But I think that people have to prepare for what is going to be a tougher 2023.
Yeah, and to end on a positive note, one of the things
sorry, y'all. That's
or just a more optimistic note. But we have seen, there has been this narrative of people leaving cities, leaving more expensive places, moving to cities, second-tier cities, or even moving to the countryside, exurban environments, where we're now seeing home prices increase because people can work from home. Curious if you think that is going to affect kind of this great migration. Is it going to stay post-COVID? Are people moving into homes further away so that they can have larger yards, larger homes? How do you see sort of the long-term effects of how housing is changing in America?
Yeah, and look, I think that while we are going to see home prices decline, we are in a very different environment than we were in 2009. And I will tell you, there is right now over 50% of homes have 50% or greater equity in the property. That was not something we had during the housing crisis. We've seen migration to new cities that I think is going to actually stick, right? We have a tremendous undersupply of homes that will help buoy the economy. So I don't think that we're going to see something as extreme as that last housing crisis. What I do think is that we are going to wipe out some of the gains that were made in the last 2 to 3 years, which is what we saw in the stock market and isn't surprising. And ultimately, I think is actually healthy. The market needs a reset. Home prices are running up a ton, and ultimately I think this will be good for the consumer because it means that home prices will become more affordable in the future.
Which is definitely what we all want. Adena, it's always so fascinating to have a conversation. Thank you so much for joining us.
My pleasure. Thank you for having me.